All right, okay. So, I posted a comment on Professor Steve Keen's most recent video, um, and said that upload, um, I'd upload a video going through my recreation of his complex economy model. And so I'm still working on that complex economy model, but I felt that I would just go ahead and start kind of giving an overview of what my models look like. So this is going to be the credit economy, the mixed credit economy model, um, that I started off by copying his models literally verbatim, um, but then I went through and I kind of organized these things in my own way. So this is maybe the third time that I've recreated that particular model, and each time that I do it, I kind of give my own twist on it. Anyway, so you'll see, I got notes from, late February when I began putting this guide together. And if I just keep on zooming out here, you can see how I organize this. So we'll just keep on zooming out. I like to use a lot of the space in in the canvas. So, if we just keep on moving out. Okay. So this is basically the whole program. You can see that I have each of the 6 godly tables in editor form. That's how I like to view these guys. Um, Underneath each of the godly tables, I have dividers, which are basically just backslashes. And in those dividers is where I kind of go through and I define each of the relevant flows. I have interest payments on loans made to the capitalist, the principal repayments on those same loans, any additional loans that the capitalists take out, the total money supply created by the banking sector. And so this is all of kind of the relevant quantities that go underneath the private banking sector's godly table. So we've got the private banks over here, and the same idea here for the private firms, because it's the turnover of the private firms, deposit accounts that define the GDP, right? GDP in purely monetary terms, fully defined by the turnover of private firm deposit accounts. We have consumption by the workers, the capitalists, and the bankers, because that all appears in the deposit accounts of the firms as well. So I basically just went through, like I said, and kind of verbatim copied, or just followed along in his 15 video playlist on, modeling MMT with Minsky. I found it very helpful. There were a couple times when his camera blocked the screen where his coding was taking place, but if you follow along closely enough, you're kind of able to piece it together. Anyway, so this is kind of just the overview of all of the different godly tables. You've got the different, the non-banks, the banks, the non-government, and the government, essentially, is the way that you can break it down. All of the relevant flows. Of course, those flows are defined via the godly table itself, right? So in each one of these guys, when I'm, actually putting these things in, I just go ahead and I open them up, and I put them in full screen mode, and we go through. We define the different asset columns, the different liability columns for each of these different entities. And then once they take some actions, for example, if the government taxes the firms, the government spends on the firms, selling bonds, paying interest on the bonds, each of those is a different flow, and you represent that flow by a symbol. And you need to make sure that the assets minus the liabilities minus the equity always equals 0. So in this column here, assets minus liabilities minus equity, you can see that all of my columns are zeros, meaning that everything checks out. And, the name of the game is basically to define, you know, the relevant flows that would take place in a realistic economy, um, and take those flows and define them in terms of the stock variables. So, the stock variables will basically just be, these different assets or liabilities. You have a stock of TGA reserves, you've got a stock of bonds that belong to the banks or the central bank, you've got a stock of equity. And all of these flows are going to be defined in terms of relationships, relationships over time, or relationships between the stocks themselves. Um, and those flows are defined by those stocks. So, for example, I have that here. I've got a flow which was the government taxing the firms, and that flow was going to be actually defined in terms of another flow here, which is the GDP that I defined over here. So this is where I define the GDP, and this is a flow that's defined in terms of a stock. Remember, I had told you that the private firms, the turnover of the private firm deposit accounts, is what I define the GDP in terms of. So that's over here. And this stock of the private firm deposit accounts will vary over time. And this time period is a time period that it takes, like I say here in the description, it's a time period in years for the deposit accounts of the firms to turn over once. Okay, and so the turnover that turnover of the deposit account of the firms is what gives me this flow here. So this this parameter of the time constant times this stock variable gives me the flow variable. But you also saw over here that I can have other flows defined in terms of flows. Okay. Anyway, so about this model in particular, all we really did was we set up kind of a basic economy where the act of lending, of the act of the private banks lending to consumers, workers, or capitalists, is the mechanism by which new money is created in the economy. And so being able to model the dynamics of all the different balance sheets and all these different flows, as the private banks or the central bank and the treasury are introducing new money and hence new consumption, new deposit account turnovers into the economy, you can see the impact that this all has on GDP, money supply, equity, etc. And so down here, I have a bunch of different charts, and I also have all of the various parameters that I defined to get the flow variables that I showed you throughout this video. And so I have parameters, time constant parameters defining how frequently consumption takes place. I have parameters defining the rate of new lending being new loans being taken out, the rate at which loans get repaid, the interest rate on those loans. And in this model so far, I have only allowed the capitalists to take out loans. I think actually up until this point, no, over here, yeah, I did. So at this point in the model, I have defined the time constant for lending and repayment for the workers as well. And so I assume the workers are taking out like mortgage loans or credit card loans, whatever it may be. And so that's all consolidated into the worker lending or the loans made to the workers time constant and the rate at which those the repayments by those workers are made. Okay. So I also have the capitalist output, the capitalist share of output. This is just some fraction of the GDP that the capitalists are able to claim, to capture. Again, you got the relevant parameters for the loans for those capitalists, and then you also have the government sector over here, the rate of taxing and spending by the government, and the rate at which interest, or rather the interest rate on the bonds that the government issues, as well as the rate at which the private banks, or excuse me, the central banks purchase the bonds from the private banks. Okay, so the bond purchases as a ratio of the deficit, assuming that the bonds being issued are equal to the deficit accrued by the government spending. Okay, because it's the case that in the United States, by law, the government must issue bonds equivalent to the deficit. And as a fun fact, the government has a limit on the amount of bonds it can sell. However, it can still go over that limit and sell even more bonds as long as the proceeds from those bonds are used to pay back previous bonds, to pay back previous debt. Right, so essentially just rolling over old debt into new debt. You can issue as much debt as you'd like if you're just going to be rolling over old debt into new debt. So that's just kind of a fun fact there about the United States debt limit, or debt ceiling as they call it. Anyway, so what does it look like when you go through all this process and you've defined some actions taken by the private banks and the workers and the capitalists? What does it look like over time? Well, let me just go ahead and real quick remind myself what are my intro settings. So, all right. So I have right now that the rate of lending and the rate of repayment on the loans taken out by the workers are going to be taking place at the same rate. So there's going to be no net new lending. That means that there's going to be no net money creation due to the workers interacting with the private banks. We also have over here, that the rate of lending and repayment for the capitalists are going to be equal. So there's going to be no net new lending taking place in the private sector, the non-government sector of the economy. Okay? We'll see in a minute why that's important. I've got a couple of different assumptions for the rate at which consumption takes place. I'm assuming that workers will basically deplete their deposit accounts within the time span of about 2 weeks. That basically just means that, the workers are living paycheck to paycheck, whereas the capitalists and the bankers can float themselves by a couple years. Okay, 2 years. So then we also have, this is just the amount of profits or the share of GDP that the capitalists are able to output. And then the turnover rate is what is the main parameter defining that GDP. So we also have that the rate of taxing and spending is going to be equal as well. So there's going to be no net government, no net money creation through deficit spending. Okay, so there's, this is basically a small government kind of model taking place right now. Okay. The interest rate on bonds is going to be 5.25%, which is what it is as of this date, March 3rd. Or at least I believe that's the Fed funds rate, the effective Fed funds rate right now, which is the relevant rate anyway. And then we also have, the amount of bond purchases as a ratio of the deficit. This is 0.5. So I have that the central bank is going to be purchasing half the bonds issued by the Treasury to compensate for the deficit. Excuse me. All right, so I'm just going to go ahead and zoom out here so we can see all of these different quantities. So I've got the GDP, the bank and non-bank equity, the amount of debt and money in the economy, non-bank equity, debt ratios, the private and public debt ratios of the private and public sector, private debt. We've got the government versus non-government equity, the growth rate, everybody's incomes, and then the deposit accounts and bank equity. So if we just let this run for a little while and then pause it, so what do we see? We see a couple things here. So we've already reached a steady state in this dynamical model, and we see that GDP has reached a steady state of about 120 billion per year. The debt and money stock is constant, meaning that there is no net money creation and there's no net loan creation, no net new lending, which is exactly what it ought to be, as we discussed, those previous parameters and their implications. The bank equity and the so if we go and zoom in here, bank equity versus the non-bank equity are mirror images of each other, reflected about the zero, about the zero line. So what does this mean? That means that the private banks, being in positive equity, necessarily implies that the non-banking sector of the economy is in negative equity. Okay, because the government is not introducing any new net financial assets into the economy. So there's no new net financial assets that could increase the equity of the non-bank sector. And because the banking sector exists, it must be solvent. And the solvency of the banking sector, the positive equity of the banking sector, necessarily implies a negative equity of the non-banking sector by virtue of the double entry accounting that underlies this whole system. Remember that all of the flows are just parameters defined by the godly tables, which are just T accounts, balance sheets. So we also have that the steady state of everybody's deposit accounts is flatlining at about 60 billion. This is for the capitalist deposit accounts and the private firms deposit accounts, flatlining at 60 billion. We do have that the workers are really not seeing much of anything above zero, which is interesting. And then we also have the private bank equity is positive, as we saw before. Now, people's incomes, we have that the wages. Now it's interesting. So we saw that the deposit accounts of the workers was flatlining at about zero, but their wages are around about 97 billion per year. Interesting. So we could just go through and analyze each of these plots. I don't want to do that in this video, but what I do want to do is to show how everything changes if I were to, say, adjust the rate of lending. So if I bump this guy down and bump this guy down so that the rate of lending and the rate of lending of the capitalists and the workers is 1%, 1% more, or 1 year quicker. It takes place 1 year quicker. The time constant is 1 year quicker than the repayment rate. That means that new loans are being created faster than they're being paid off. Okay, I'm going to keep the government behavior the same, but we'll notice what is going to happen. What is going to happen to the GDP? What is going to happen to the debt and money stock? And what is going to happen to the bank versus non-bank equities? So if I press play now, so you can see it takes off. All right, so GDP is increasing, the bank equity is increasing, the non-bank equity is decreasing, and the deposit accounts going up, up, up. Interestingly, the workers' deposit accounts are also going up as well. The workers' wages are going up. So we can see that the debt taken on by the capitalists, actually, as a matter of fact, if I reduce the rate of lending to the workers and I resume, So I'm just going to let this run here. And so if I put the rate of lending for the capitalists back to equal, you see that the GDP flatlines. I've already set the rate of lending for the workers back to equal. You see that the GDP flatlines. The workers' wages flatlines. Now if I have that the capitalists take out more loans, the workers' wages increases. Okay, so this automatically shows that the deposit accounts of the workers is a direct consequence of the capitalists taking on debt to finance the creation of goods and services, and creates more consumption as well. Okay, so one more thing before I end this video here. So I put the rate of lending back to 0, so no new net lending. But let me now introduce a government deficit so that the rate of taxing as a percent of GDP is now less than the rate of spending. And you can see that the money supply goes up, 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 up. GDP also going up. Debt ratio of the private sector going down. It's going a little bit slow here, but nevertheless, so we can actually go ahead and cut that out. But the basic gist, let me see if we can. There we go. The basic gist. So we see that the debt ratio of the non-government is going down because they're actually getting more net financial assets onto their balance sheet without taking on any additional liabilities, without taking on any additional debt. So their debt ratio is going down while the debt ratio of the government sector is going up. GDP is going back up. Incomes are going back up. Economic activity is going back up. And the government versus non-government equities are mirror images of each other. Okay, so we have that from earlier, the bank versus non-bank equity is going to be mirror images of each other, but also the government versus non-government equities are going to be mirror images of each other. And again, this is just by virtue of the fact that double entry accounting necessitates that the assets of one entity are the liabilities of another. Okay, so now you can let this go ahead and play a little bit, and if I go back to, whoops, that's the wrong parameter. If I go back to equal rates of taxation and spending, boom, the GDP flatlines again. Debt and money stock flatlines again. And now, if I have that the government taxes more than it spends, right? If I have that the government taxes more than it spends, whoops, rate of spending on the firms, that's the wrong parameter. It's this one, rate of taxing. Then the GDP goes down, money supply goes down, okay? And we'll see that the debt ratio of the government will begin to fall, but the debt ratio of the private sector will begin to rise, okay? So, there we go. So we can see that trending now in the opposite direction. I wonder if I decrease the speed of the simulation, this will run a little bit better. There we go. Well, maybe not. It's kind of taking up a lot of resources from my computer to display all of these graphics. But anyway, just wanted to basically take a little bit of time and just show how I've been arranging this. Now, once I have gotten into defining quantities like the employment rate, the wages share of output, and a couple other, population, and the rate of increase of the population. Once I've defined those kind of flows, I'll be able to start building the complex economy model and actually being able to show graphics in these plots that aren't just these kind of exponential curves and straight lines, but we're actually going to get some waveforms and some chaotic waveforms actually. So that's going to be really interesting. I can't wait to put it together. And until then, I will see you all next time. Thanks.